So good afternoon, good late afternoon, everyone. I thank you so much for sticking around. I'm really overwhelmed with how many people actually stuck around this long. I know it's been a long day. I know you've been to a lot of presentations. So I'm going to try to make this as straightforward and not overly long as possible to maximize the time for Q&A, because this is actually a fairly complex subject. I'm going to try to make it as simple as possible, but obviously I'm going to have a good deal of questions. Just to be perfectly clear, I probably did a less than exceptional job putting a title on this, because this is a bit ambiguous. It says using options to trade currencies, but I'm not actually going to talk about trading currency options. I'm going to talk about using options volatility expectations to predict currency price moves. So if you were expecting a class on trading currency options, this isn't exactly it. I'm sorry to disappoint anyone. But before we start, and you've been to enough of these that you know I'm required to put this risk disclaimer up here. But more than the requirement, I personally feel that it's important to point out that I'm a fallible person. The last thing I want you to do is take anything I've done here and trade it blindly, because that's not a good way to trade A, and B, because I'm not always right, far from it. I'm going to give my honest opinion, and I hope it's legitimately useful to you, but do your own homework, and definitely don't, not only me, but try not to follow anyone blindly. So why do we care about Forex options, or Forex options prices and Forex options as a tool to predict currency movements? If you've seen my SSI presentation, you've probably seen a couple of these slides already. But the real important thing to know is that the FX market is decentralized. What does this mean? Well, there's no New York Stock Exchange for the euro-US dollar. It's just a bunch of different banks. It's a bunch of different aggregated feeds, such that there's no one central place where we can get volume data, where we can get open interest data. One of the major tools, and if you've been to my SSI presentation, I talked about the FXCM Speculative Index, which I really like. But I also, obviously this presentation is about options, and I think it's another really significant tool that can really give you a legitimate edge in your trading. So again, you've probably seen this chart already if you've seen my presentations, but we're looking at a chart of the S&P 500. And the immediately striking thing is that we're able to see how many trades are transacted in the S&P 500 on any given trading day. The literal and figurative color that this adds to our charts is basically saying, well, I can basically see, all right, well, the S&P 500 has been tackling new highs every day. I mean, I know today it lost 3%, but it's basically been on an incredibly consistent path. The critical thing to note, however, is that volume has generally been on a downtrend. The biggest volume days have tended to be the down days. So as a technical analyst, a lot of people would say, all right, well, the S&P 500, there's limited buying interest because it's floating higher on essentially lower volume. On the euro-US dollar, which is obviously side by side with the S&P chart, you don't have any such information. While this would be extremely helpful to have here, like I said, the FX market is decentralized. I trade with this bank, that bank trades with another bank. We all go through Reuters, et cetera, but it's just not the same. So one of the major tools that I use is the Commitment of Traders report, which basically underlines, it's a report published by the Commodity Futures Trading Commission out of the United States, and it gives us color. It gives us information on who's trading what and what specific market actors are doing. Now, the COT is great. I really like it because it breaks trader groups into individual subsections. So in terms of futures traders that are trading currency futures, there are going to be a lot of companies like Toyota and BMW and what have you that basically want to hedge against their currency exposure. And what they do is, let's say they have to pay something in euros a year from now, they'll buy a bunch of euros to lock in that currency price. That's not really interesting to me because, that's something they have to do. That depends on their sales, not what they think about the market. I'm much more interested in knowing what the speculators are doing, and that's what non-commercial traders are doing. So in releasing this report, the CFTC gives us really good color on the market. Obviously, this is not a presentation on the COT report, but I like to point this out because I think that this is actually one of the best tools to really gauge speculative interest in the FX market. The major caveat, and the reason that it's not a great trading tool, is that A, it's released only once a week, and when it is released, which is approximately Friday at 3:30 Eastern Time, it's using Tuesday's data. So you're only getting the data once a week, and you're getting data that's a few days old already. So it's significantly less actionable. In comes, the motivation. Well, if you saw my SSI presentation, you saw that SSI is a major component to gauging sentiment, and it has its real advantages. I also like FX options a lot. And why do I like FX options? Because when I look at FX options, I know that some of the biggest, most sophisticated traders in the world are going through FX options and expressing their opinion, whether they're betting that the euro will appreciate or scared and they want to hedge their exposure. There's real money on the line. And whereas, I might look at a report to say, all right, we expect the euro to go higher, I tend to believe you if you say, I'm going to bet $10,000 on this. I believe that you're bullish because otherwise you wouldn't put your funds at risk. So don't be intimidated by this diagram. We're going to talk a little bit about a couple of different factors that are critical to understanding how we can use FX options. It's important to learn the basics, and I apologize in advance if you know options. This is going to be a little bit basic, but it's really important to understand exactly what's going into what I'm going to discuss a little later. So ignore this formula. I don't need you to know this formula at all. What I want you to know is that FX options, or options in general, not necessarily limited to foreign exchange, are tremendously complicated, but they use a variety of factors to determine price. So just to recap, if you're not familiar with option, a call option is the right to buy a specific asset. Let's say in the case of a euro dollar, I have a call option with a strike price of 130. That gives me the right, not the obligation, at a predetermined date to buy the euro dollar at 130 at a future date. That means that if the euro rallies, well, I can buy at a lower price, so my call option is actually worth more. A put is the opposite. The put is the right to sell, not the obligation. So already you see that a call is a bullish opinion on the market, or you just need to buy something in the future. A put is a bearish opinion on the market, or you need to sell something in the future. And it's important to note when these things make money. So this is a basic options payout graph that basically tells you, all right, well, I have my strike price right here. That's called at the money, or ATM for short. If something is at the money, it means that it's currently trading at the strike price. So for example, I have the euro call at 130. I have the right to buy it at 130. That's my strike price. If it expires at my strike price, I'll probably lose some money because I had to buy the option. I had to pay for the option. If it goes above my strike price, I say it's in the money. It has intrinsic value. And if it's below my strike price, it's out of the money. It's basically going to expire worthless if it stays there. So understanding in the money, out of the money, or moneyness, which is how we refer to this term in options, is significant. And one important thing to note, this isn't necessarily intuitive, but I need you to know that something that's really out of the money has a very low delta. And I'll explain delta a little bit more, but delta is basically, all right, so I have a call option. It says that I have a right to buy euros in June at 130. Well, how much will my call option move in price with every point that the euro moves? If my option is really out of the money, then there's a low probability that my option will have value at the end. So delta is very small. My call option is not going to move very much in value given volatility in the euro. If it's relatively in the money, there's a high probability that it'll expire in the money, and as such, it'll move quite closely with the euro-US dollar price. I know that's a lot to absorb right away if you've never seen this before, but it's an important topic that we're going to flesh out a little bit more. And obviously the opposite is true with put options, because the put option is a right to sell instead of a right to buy. So you just reverse everything I just said for the in terms of strike price, delta, into the money, in the money, out of the money, at the money. Or at the money stays the same, obviously, but in the money means something different for puts than for calls. Another critical factor, and literally what this presentation is about, is, like I said, I didn't expect you to look at the generalized Black-Scholes equation that basically determines market or the options price. But what I do need you to know is that the higher the volatility expectations for something, the more expensive, the more I'm going to have to pay for an option. That's true of calls or puts, and it really doesn't necessarily depend on direction. So this is, I'm plotting my option premium, or the price that I have to pay to buy the option as it relates to volatility expectations. Volatility expectations are one of the major components of option price. So when I talk about implied volatility, that's basically extrapolating how volatile markets expect that specific asset class to be in the specific period. If volatility expectations drop, then my option is worth relatively less. If they rise, then if I'm long the option, then my option will appreciate. So, again, don't be intimidated with this chart. Again, remember, one of the major factors, and what I really care about right now, is volatility expectations on FX options. So we're going to see, this is a 3D chart that I just threw on there because it looked nice. But, I'll explain this a little bit more in depth in just a second. All you really need to know at this point is that as volatility expectations go up, it implies that the option is more expensive. People are willing to pay more. People are requiring more if they're to sell it. If implied volatility is low, the option will be relatively cheap. So already you see that just by looking at the options price, you know exactly how volatile markets expect the euro-US dollar is going to be, between now and June, let's say. So we use the concepts of moneyness and volatility expectations to gain a view of how markets feel about a specific asset class. Volatility expectations are great in terms of determining market expectations for how much a thing is going to move. But what I really care about is how people feel about the specific asset class. Are people really bearish? Are people really bullish? So this is what's called the volatility smile. Now, it looks like a smile, so that the name is obvious. But what I want to point out is that at the money options are typically the cheapest as it relates to volatility, or you pay the least in volatility for at the money options. As you go further out of the money and it's a more speculative position, well, then people are willing to pay a little bit more because they're willing to make a more speculative bet, and sellers of options are requiring higher premium to absorb the risk that this relatively cheap option will expire in the money. So again, we're combining the concepts of moneyness and specifically delta. So again, remember, delta is the amount in price in dollars, or whatever currency that the option is priced in. It's the amount that the option will move for every point that the euro-US dollar moves, just to keep things simple. As we go away from the strongest, or delta is basically 50 for an at-the-money option. It's approximately 50. In practice, a little different. But basically it means that my option is going to move half as much as the underlying currency. As I move further out of the money, and we see delta going to 5 here, which is very low, that's a really aggressive bet. That's a really out-of-the-money bet that the euro is going to fall and you can see that people are willing to pay a lot of money for this. On the call side, you also see that there's a significant premium for significantly out-of-the-money calls. So again, when I'm saying out of the money, right now the euro is at 130. An out-of-the-money call or a right to buy the euro, let's say a really aggressive one, would be an option to buy the euro at 135, which is 500 points away. If I buy that option, it's going to be pretty cheap in terms of price, but it's going to be a really speculative bet because that's a big move for the euro, 500 points. So that's what I'm talking about delta. That's going to be a very low delta option. On the flip side, the low delta put, if the euro's right now at 130, I'm buying a put that gives me the right to sell the euro at 125. So I hope I've got it relatively clear. I mean, do people have questions at this point about delta and how it relates to volatility expectation, or what delta means and how it relates to the call and puts? Yes?
Do you have a probability chart like they do in equity markets for this?
That's a good question. Do I have probability charts for this? I don't, but essentially I think the best way to put it, and I'm glad you reminded me of this, I think delta is basically a sign of probability of whether my option will expire worthless or whether it'll actually have value at the end. So if my option is really out of the money, delta is going to be very, very low because there's relatively low probability that my option will expire with intrinsic value. So that's a very important topic to keep in mind.
Do you try to trade delta neutral?
That's a little bit different. That's the question was, do I try to trade delta neutral? That's an options trading strategy. That's a little bit beyond the scope of this presentation. So we'll talk a little bit about volatility expectations in a second. Yes?
135 would be the call.
So if the euro's right now at 130 approximately. A really aggressive call, a really out-of-the-money call would be at 135. A really aggressive put, because remember, the call gives you the right to buy an option, buy the underlying asset. So obviously, I'd want to buy the euro as cheaply as possible. An at-the-money option would be at 130. A really aggressively out-of-the-money option would be at 135. Given that the put is the opposite, an aggressively out-of-the-money put would be at 125, let's say, because there's no way I'd want to sell the euro at 125 right now if it's at 130 as the current spot price. And you can get a sense for why the option price really won't vary very much if you have such an aggressively out-of-the-money option. You can think of it just as the probability that this thing is going to have any value at the end of its life. Okay, so here's the meat and potatoes. This is what I'm really getting at. Given what I've already said about volatility and how it's such a critical factor in determining the demand and the price that people are requiring to accept for a specific option, you can basically see how much people are willing and able to buy that option at that price, at that delta. And here we have a volatility skew. This is actually the same thing as I just showed, but what I want to point out here is that the very aggressively out-of-the-money euro-US dollar puts are significantly more expensive than the aggressively out-of-the-money euro calls. So what's that telling me? Right now that's telling me that people are willing to pay significantly more in terms of volatility for puts, which means that the investors are paying a lot more for that put at 125 than they are for that call at 135. Again, that just tells me that on balance, markets are really bearish. And this is actually something that we can quantify into one single number, and it's called a risk reversal. So we could, I'm sorry? That's a good question. Is this chart available from the trading station? I'm afraid not. This is the Bloomberg Professional Service. So all of the data I'm discussing right now is over-the-counter options data from professional data services. Unfortunately, it's kind of difficult to find this information for yourself. of course, I'm going to get to a report that I write for dailyfx.com that I think could be legitimately useful for the smaller investor. So a risk reversal quantifies this big difference in demand into one single number. If we want to standardize something, we want the same delta for the put and call. Let's say 25 delta is probably the most common. 25 delta means that for every point that the euro-US dollar moves, my option moves 25 cents. Depending on whether I have a put or a call, that means that I'm bearish or bullish. But to look at the equivalent, we basically choose 25 delta puts and 25 delta calls, subtract these, and then produce a single number called a risk reversal. A risk reversal just tells me if people are willing to pay more for puts, out-of-the-money puts, or pay more for out-of-the-money calls, and it really distills this information. So right here, I have a chart that I post on dailyfx.com. It's plotting Forex options risk reversals, and this is actually the COT information that I was speaking of earlier. And what we see is that on balance, FX options risk reversals tend to move a lot more than the non-commercial positioning does, but they tend to move in the same direction. So if everyone in futures is betting that the euro is going to fall, if the speculators are betting that the euro is going to fall, you're probably going to see that in FX options risk reversals. And that's the meat and potatoes. That's why you're here. That's why we're talking about FX options right now. The risk reversals are showing that people are willing to pay a substantial premium for euro puts, and that roughly coincides with an aggressively net short speculative futures position. And again, since the COT data is on a delay, the fact that we can receive the risk reversals information more frequently really makes it a little more useful for actual trading. Did I have any questions at this point?
You're not talking about options on futures, the options traded over the counter. I didn't quite understand.
Good question. The question was where am I getting this options data? And again, it's from over-the-counter data. So I just go to Bloomberg, which aggregates options price feeds from a number of banks, and they publish, implied volatility. Question over here?
This chart, so on the right side it says like a -5 to the fourth, and that's the negative, and above that dash line that would be the positive.
Yes.
You could actually use that, so it's actually the negative. That means puts are more expensive, correct?
Actually, that's the net non-commercial positioning. So that means that non-commercials, large speculators, according to the Commodity Futures Trading Commission, are actually really heavily net short the euros. And this was taken not that long ago, maybe a month or so ago. And this is actually, I know for a fact that this is still true. Speculators are still very heavily net short the euro-US dollar. Okay, so what this is, and this report, I like risk reversals a lot. I don't publish the actual number. Why? Because of the vagaries of the FX options market, that number itself might be actually a little bit misleading. Long story short, I publish, how bearish or how bullish markets are in relation to the past 90 trading days. So that's why this goes from 0 to 1 instead of negative and positive, because I'm gauging how bearish or how bullish FX options traders are in relation to the past 90 days of trading. And, sorry. Exactly. Not exactly, but it tells you that it tells you that people are more bullish than they have, or on average, more bullish than they have been in the last 90 trading days in FX options on the euro-US dollar in this case.
Does it relate to calls and puts at all in there?
It relates exactly to calls and puts right now.
Above the red line is calls and below the red line is puts?
Roughly speaking, yes. Question over there? the question is whether you can get that non-commercials positioning data. You can, right off the CFTC's website. They'll release it once a week. To get it into graph format, you'll have to do it yourself with whatever spreadsheet program you use, but that data is freely available. FX options is a little more difficult to find. They provide spreadsheets, so you can actually see this historical moves in each of these. Yes?
Right now it's a bearish.
It's very, in this chart, it's very bearish. So everyone in the futures market is very heavily net short euros, and in the options market, you're seeing something quite similar. Everyone's really betting that the euro is going to continue declining. And this was taken a little while back. But before I get too carried away talking about FX options, I want to talk about why we actually care. I could talk till I'm blue in the face about risk reversals and so on and so forth, but obviously I want to leave you here with something actionable, something that you could actually use in your everyday trading. And this is something that I've been researching for a little while now. How do we trade this information? So if you attended my SI presentation, you know that I like simple trading strategies. This is relatively simple in terms. So this is kind of like a range trading strategy using risk reversals. I'm going to buy the euro-US dollars when the risk reversals are the most bearish, basically the lowest fifth percentile in the past year. I'm going to close that long position if it goes back to the 45th percentile. Sell when risk reversals hit their most bullish in the top fifth percentile of the past year. Close the short position if it pulls back to the 55th percentile. Notice that I'm using consistent distances from 50, which is neutral. So top fifth, bottom fifth, 55th, 45th, and I'm trying to standardize this trading so I'm not getting too complicated. I'm not trying to over-optimize. Here's a chart of exactly what this means. So right here, this is the risk reversals percentiles. When it hits 1 or close to 1, you would have sold the euro. And this is admittedly a cherry-picked example because it worked extraordinarily well in this situation, and it's not always going to work that well, to be perfectly honest with you. But you see that the risk reversals tend to top or hit their top or bottom at fairly important junctures across the board. Right here you see it when the euro hit close to 145 and pulled back substantially. Again, a short-term top, and again here on the way back up, options actually became fairly bearish, and you see that the risk reversals were hitting bearish extremes. This strategy would have gone long. And this is the equity curve that you can see for the past approximately 4 years. I only do 4 years because I actually honestly don't have access to that much risk reversals data because it's a little difficult to find even if you have a professional Bloomberg terminal. So this is the past 4 years of trading data for this specific strategy. It looks really impressive. And if you look back at that chart, you can see why. I remember I wrote an article about this right around here when I said that this strategy has actually been working tremendously well. And I put it up on dailyfx.com. And sure enough, the euro didn't top for a long time, but that was good for a couple of weeks. That top stuck for a little while. So you're starting to see why I get excited about something like FX options risk reversals. Now, the important thing to note is that what works for one currency pair doesn't necessarily work for the other one. So that same range trading strategy worked for the euro because it's basically been in a huge trading range for the past couple of years. If you look at other currency pairs that haven't been in that same kind of trading range, it has not done nearly as well. You can see that the British pound has fallen substantially since 2006, and as such, this range trading strategy using risk reversals hasn't worked nearly as well. So we modify and we have a second system for these more trending pairs that over the long term have hit further lows and further highs on a more consistent basis. So it's basically almost the exact opposite as previously. So we're actually buying when FX options risk reversals are at bullish extremes, selling when they're at bearish extremes, and you're seeing the same numbers here, except that I'm a little more aggressive when I'm taking profits. When it drops back to 70 or 30, then I'll close the position. And these are the results in the British pound and the Australian dollar pair, which, like I said, have lent themselves to much bigger and longer term trends, that this kind of strategy has actually worked really well. This is the trend following risk reversals trading system, and the previous one that worked on the euro so well because it was trading in a really big range was, what I would call the range trading risk reversal strategy. If you want to find this information, like I said, FX options risk reversals data is difficult to find unless you have an account at a major international trading bank, or you have something like the Bloomberg Professional Service, which is very expensive. But to that effect, I write an article about FX options every Wednesday where I post these exact graphs highlighting these risk reversals and their percentiles, and I'll also put words to that graph, obviously, and how we might actually trade using this information. So I'd like to open the floor to questions. I probably will have a lot, and I'd like to hear what you guys think about this. Sure. So you go to dailyeffects.com, you hit technical analysis. Under articles, you'll have the Forex options weekly forecast. And that's exactly where you can find this information. Question? I have laid over SSI over the COT data, and it's basically goes in the opposite direction. So I would expect, or I'm fairly confident that the risk reversals data would go in the opposite direction as the SSI. Yes? No, I'm selling or buying the currency itself. No, I'm not trading options at all. I'm just looking at options so I can trade the underlying currency. Yeah, I'm buying or selling a position in the underlying, in the currency in this case. All right. This is obviously a bit more of a swing trade. The question was, what time frame would this work best for? This is definitely a multi-week trade. This isn't a very short-term trade, not the least reasons of which I publish this report once a week, obviously. So you're not going to want to take short-term 50-point positions in something that gets published once a week. This is kind of trading it, let's say, a couple weeks at a time. Questions in the back? The question is, can you sell covered calls on the spot position? And covered calls is just a specific option strategy that you own the underlying and you're selling calls on it. If you have access to an options trading platform, you certainly can. FXCM doesn't currently offer, or it used to offer, it no longer offers options, but there are some options, no pun intended, there are some options out there where you could find currency options. Sure. Okay. Question? That's a good question. This is something I started paying attention to literally a couple of months ago, and I noticed that it worked extraordinarily well in the euro-US dollar. So obviously past performance is never a guarantee of future results, but for instance, and pardon me, I'm going to change the slide for a second, right around here I saw that this strategy had been doing really well. It caught this top to perfection, and this one too. So right here when I saw it hitting 100%, I wrote an article saying, this looks like it might reverse. Past performance is never guaranteed, but it's been fairly dependable in the euro-US dollar through the past several years of trading. Like I was discussing it works better as a trend following strategy with other pairs. That's something I've found, that the euro dollar is the only one that it trades really well on in this range trading strategy. Question at the back? No. The question is if currency options expire on the third Friday of every month, as they do in equity markets. I'm using over-the-counter options data, so they have no fixed expiration. The expiration is determined by the tenor at which I'm drawing the information. So if I choose 1 week options risk reversals, it's options that expire in 1 week. Since they're OTC, they're perfectly tailored to whatever the client is buying or selling. That's also a good question. If there's any way to see essentially volume in the options data, I'm personally not aware of any sources for the volumes data, short of asking someone like UBS to tell you how many options traded, and they're probably not going to do that very easily. We do not have a put call ratio on our site. Oh, on Bloomberg, definitely. Questions? Yes?
Would not be quite as time-consuming as some of the other strategies. You're using this as an indicator to tell you which way to invest in.
Yes.
Because of the length of the information coming out, it's a longer term.
Yes. The common question was, this is less, you pay less attention to this because it comes out so infrequently, and it's definitely more of a long-term view on the market. I'm definitely more of a multi-week, I like to hold positions for weeks at a time. So I like stuff like this because I can look at it on 1 week, open the position, and obviously I'll have to place a wide stop, but I'll leave that position on for a couple weeks at a time if it works in my favor. Question? It's a good question. The question is, probability-wise, if we're using this, what else would I be using with it? Things like the COT report. So it's no coincidence that I put non-commercial positioning on here. I want to see exactly what different market actors are doing. I'll put COT positioning right here as well, just to get a good sense of what's going on. The COT, talking about COT strategies is a bit beyond the scope of this presentation, but for instance, if I'm seeing that both of these are really, really oversold, then there's a reasonable chance that the pair is going to bounce, for instance. You can definitely overlay this with things like the SSI. The SSI is a much shorter term equivalent. So in terms of overlaying, there are obviously countless options, but those are the ones that I would personally use. Yes?
On a chart, where do you find the 5 and the 90, the 5 and 45%? Where is it?
Right here. So the question is, 5th and 95th percentile, where do they show up on this chart? Right here. This axis on the left tells you what percentile. So the very top is 1, the very bottom is 0. And you can't read exactly which level this is, but I will definitely be writing about that in the report. I publish this once a week, and I add, a paragraph of text in addition to this chart.
Is the dotted line across, is that the 5?
That's the 50. So that's the neutral level. That's saying that people, the FX, or the options trading crowd, is essentially neutral as it relates to the past 90 days of trading. The 5 is down here.
Oh, very good.
0.05.
Very good.
Yes, exactly.
And the 0.45?
0.45 is just below the neutral dash mark. I'm sorry, it's a little... I'm sorry? It's right here. For this specific strategy, I'll buy or sell at the 95th and 5th percentile. I'll close it when it basically corrects. So that's for the purposes of this strategy. Those are the parameters I chose that found that worked on pairs such as the sterling and the Australian dollar. Yes? Yes. I don't necessarily write this in every report, but I'll write about these specific trading strategies, and maybe I'll write a sentence on what you would do if one of these conditions is triggered. Every week, yes. Questions? Yeah, well, I thank you so much for sticking around as long as you have. And good luck trading, and thanks so much for coming to the FXCM Expo. Safe travels home.